Bank of England Governor Mark Carney has made it clear that the bank is standing by to take action that may be needed to come to aid of an economy here in the UK that's showing signs of strain. With a rate decision due on Thursday at noon, will the Bank of England deliver? Bronwyn Curtis is an independent economist and is on the Times newspaper's shadow MPC. She joins us now. Bronwyn, welcome.
Thank you.
First of all, what's in the Bank of England's toolkit? What can it do?
Well, now there's not a lot it can do. So last week it actually cut capital requirements for the banks, and that should loosen up about another 150 billion to lend, as long as companies want to borrow. The other things they can do, of course, is cut rates or do more quantitative easing. That's buying of bonds, either government bonds or corporate bonds. So, and they can do targeted things, but it's really, really difficult now because rates are really low. Taking rates lower, will it make any difference?
You remember, as I said at the top of the shadow MPC that's set up by the Times newspaper. I believe it's all been released this morning, is that right? And I think you went for a cut of 25 basis points. Why?
Well, I think that Mark Carney had already pre-announced it, which he shouldn't do because the Monetary Policy Committee, they're all independent people, they all have a vote. And he talked about cutting rates. Rates would have to come down in the next few months. So if you've pre-announced it, you might as well do it. He says it was only his opinion, but of course that carries a huge amount of weight. So I think if you don't want to undermine the credibility of the Bank of England, you probably need to do that rate cut. But I would not have done it, and I have voted today to cut rates only because it's a done deal and we don't want to undermine his credibility, but I wouldn't have done it.
The quantitative easing you mentioned, I think there's already £375 billion already out there in the market from the Bank of England from Mervyn King's round 5 or 6 years ago. Do you see that that is a good option? Did QE work?
It worked initially. It really gave a boost to the economy initially when it was first done all those years ago. But I think since then it's had less and less effect. And of course now we've got government bond yields 10 years at record lows or close to record lows, and corporate bond yields, the spread between corporate bond yields and government bond yields is also at very low levels. So what will the QE do? It doesn't, it's really hard to see it making a difference.
Where we are at the moment of 0.5% on base lending rates, do you think that the Bank of England missed an opportunity to raise rates 6, 8, 10, 12 months ago last year when things were looking better than they are at the moment? That would have given the bank a little bit more room now, of course. Do you think that, looking back, might have been a better policy to have moved with?
I do. Actually, I voted for hiking rates last year a couple of times on the shadow MPC panel because I felt that it was an opportunity, exactly that. It was an opportunity to take rates up a little bit, probably just 0.25%, 25 basis points, and it did give room where if the economy slowed. They didn't do that, and I think they did have the opportunity. Of course, you have to talk about these things for a long time in the same way that they did in the US before they made that rate hike just recently.
Of course, the other thing is, I suppose, is the bank doesn't necessarily have to move in 0.25 percentage point moves, does it? It could make a smaller move. So if they do go 25 basis points this time and the economy does show further signs of stress, first week, I think it's first Thursday in August, the bank releases the quarterly inflation report. Do you see them possibly going again, if they do move tomorrow, going again in August?
I hope not. I think that actually the inflation report is the best time. If you're going to make changes, that's the best time to do it. And that's because it's a big report. It lays out exactly where they see the economy going and what will happen and why. My problem now is that we've already seen this huge drop in sterling, and that's equivalent to cutting rates already. So we've already loosened monetary policy, and I think if we cut rates again, it might take it down again, and at some point you worry about instability. But hopefully they will hold fire until we start to see some real economic data coming through.
And of course, if they cut rates, then it drops savings rates as well. Everybody thinks about loans, mortgages and everything else. Everybody says, oh, that's nice because I've got a bit more money to spend. But there are a lot of people in the economy that actually rely on income from savings, and they're getting even less of that if we see another interest rate cut. How is that going to affect that part of the economy?
Well, that is quite a problem because, of course, those with savings are the older people who are looking to live on those returns from their savings. It also affects pension funds too, of course, because, you know, the pension black holes get bigger and you don't get the returns. And so it is a big problem. So I do think they stop spending is what they do. The ones with the money stop spending, might bring mortgage rates down a bit, but of course bank margins are being squeezed now at the same time because long-term rates, what banks like is a steep yield curve, you know, so they borrow short at low rates and lend long at higher rates. Well, you can't do that now. So their margins are being squeezed, so mortgage rates aren't likely to come down either.
One final question is, we're talking about monetary policy. What about fiscal policy? We've got a presumably new chancellor coming in, or certainly it's a new regime under Theresa May. What fiscally could be done to support any help for the economy?
Well, I think now it's the combination. I think monetary policy and fiscal policy have to work together. So it has to be much more joined up than it's been. You can't rely on monetary policy. I think on fiscal policy, that is a much bigger lever. Now, what can they do? Well, we've already had George Osborne talking about cutting corporate tax rates down to 15%. I actually think that's quite a good idea because I do think there are companies that are thinking of going, so I think that will help. I think they have to loosen fiscal policy because, you know, tax revenues are going to be less. No matter which way you cut it, a lot of revenues come from the City of London, of course, and some of those tax revenues are going to go to Europe because companies and banks will be risk averse. So some of that will go to London. So you've got to loosen monetary, got to spend more. Rates go up, growth goes down. I mean, you know, it's sort of growth, I mean, inflation goes up and rates go down. I think we're back in that stagflation situation.
Not a good word. But great to hear. Thanks, Bronwyn. Thanks indeed for joining us there. Bronwyn Curtis with a look at the interest rate decision from the Bank of England due at midday on Thursday. We will be live here on IG.com trading that decision from the Bank of England when it comes out with its interest rate decision. Will it also shift on QE?